The Wyckoff method is what I trade, and I trade it at an institutional level. And I've taught hundreds of others to trade the exact same way. I'm not a financial advisor, so I can't actually tell you how to use your money or where to put it. I'm just showing you how I do it and how I make money. What is the Wyckoff method? Supply and demand. Think of it as if you have a balancing scale. You have two plates, and on one side is, how much you have of something, and on the other side is how many people are willing to buy it. And this kind of balances between each other, on this balancing scale. If there's more of one thing, it's going to be less of the other. If there's less of one thing, it's going to be more of the other, So I guess this way. So there's this balancing act going on, and you can identify that with anything. I use a lot of analogies throughout this course, but one of the prime analogies that I use is with the car. This is the one that usually most people are able to make sense of. If you have a car, it's usually at a certain value. Now let's say you're trying to sell this car on Facebook Marketplace. Well, if nobody wants to buy this car at $5,000, more than likely, you're going to start to move it down in increments, right? You're going to continue to move the price down until you find interest and you find a buyer. This is what I call demand. Now, supply is this, right? You have one of this car. That's the supply. Well, when you find demand, somebody's going to buy this car, and then you're not going to have a supply because this is only one car. Now, it's a little complicated because you only have one car, and that's called a monopoly. But we'll get to that in a second, okay? But supply has a big effect on demand. Let's say, there's multiple people selling this car, not just you. So now the supply is more, right? Now you're not the only one deciding this price because there are other people selling this car for a different price. And the difference between these prices is what I'm talking about sideways movement. That's what I'm talking about sideways price movement. Because you're going to be at 4,000 and somebody else is going to be trying to sell it for 6,000 at the top of this range. And in the middle, this is where price is kind of moving back and forth between you two or between multiple people. So at a certain point, the buyers are going to say, maybe this is less valuable. Or they're going to say, actually, this is more valuable. And that all depends on how much supply is here and how much demand is here. If there's a lot of demand, then that means the price is going to go up. Because if there's a lot of people willing to buy, you're not going to be going down anymore. You're going to be raising your prices, right? You're going to find people to buy at higher prices. Meaning you won't have to go so low as you were doing before, going down in increments. So there are certain things that can affect demand. So for example, let's say the car that you're trying to sell has a lot of mileage. So like 250,000 mileage. Well, that's probably going to lower your price a little bit because there's not going to be so many people willing to buy that at 4,500, maybe, possibly, right? Or let's say the paint is ruined and and the inside looks bad. So all of these things that are affecting how many people want to buy this car at the certain price. This is going to affect demand, which is buyers. And obviously that's going to drive the price down further and further, the more things that are going against, something that will entice somebody to buy this car. Now the opposite is true, right? If instead maybe you get engine swap and you have a lot, like really low mileage. And then let's say, you get a paint job and it looks really nice now. Then you get it detailed, the interior detailed. Now, it might actually be worth more than $4,500. And you might find a lot of people willing to buy it at this price. So you're going to raise your prices up into, like 6,000 or 7,000 or above. So again, the opposite is true with demand, that if there are good things for it and there's going to be a lot of things to entice buyers, then the demand is going to go up. And again, there's this balancing scale, right? There's a scale here. There's this scale of supply and, demand, buyers. Now, when demand rises, they're going to start buying this car and your supply is going to get lower. So let's say buyers move up, supply comes down. Well, eventually the price is going to get so high, 9,000, 10,000, that eventually buyers are going to be less enticed. And so the demand is going to come down. And as it's coming down, the supply is going to come up because less people are buying it, right? So there's going to be more of a supply. And there's this balancing act going on where we're trying to decide and find the true valuation of whatever it is. Now, in something more complex than a car, this balancing act can go on forever because maybe multiple aspects are changing on whatever it is that's being evaluated. For a car, eventually it might find its true valuation. But for things like gold, for example, is constantly going back and forth trying to find a true valuation. And that's because multiple things are changing with gold and it's always changing. And the same thing goes for anything else, but I'm not going to get into that yet. I'm just going to show you that, as you see price moving back up and down through this chart, because that's all you're seeing, right, is up, down, 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 up, down. And then there's little mini movements up, down, up, down, up, down, because there's little mini decisions of how valuable is gold, right? So real example here, but this is what we're doing. And so what I'm teaching you is not only to identify where buyers are and where sellers are, based on this graph of price history, of price action, how the price has acted before. We're going to figure out where the buyers and sellers are so that we can make educated decisions and start trading profitably. But then what I'm also going to teach you is there's going to be certain events that you can identify people with large amounts of money. Because think about it this way. At this point, there's not only a few people selling a car, there's hundreds of millions or billions of people trading this, commodity. So what it takes to move this price up and down is going to be a lot. And so if there's somebody out there who can move this price by themselves, more than likely we want to follow them. And so what I'm teaching you is not only to identify buyers and sellers, but I'm also teaching you to look for events that show evidence that these people with a lot of money are here and trading the same thing that you are. And then furthermore, we're going to follow them and try to trade with them instead of against them, right? Because if they're moving the markets, obviously we want to be with them, not against them, right? So that's what we're doing here, and that's what I'm teaching you. Now, this method that I'm going to teach you, you're going to have to study behavior, price behavior. And in these price behaviors, I'm going to teach you different stages of the price. So there's going to be stages like continuation up, continuation down, but then there's also going to be sideways movement. That should be essentially all you need to know before you start this video course to then set the stage for you to become a profitable trader. Now, I also want to explain to you, the different things that we trade. So there are common stocks, and common stocks are the stocks that you pretty much know about. It's the companies like Nike and Apple and Starbucks and all those single companies that have, parts of the stocks that you can buy the company, part of the company of, and you might get a dividend or whatever else, but you have part of this company, a fraction of it, through a stock. And that's what most people know about. Then there's penny stocks, which is the same thing, but just with companies that are valued at pennies per share of their company, per stock of their company. Share meaning a piece of or one stock of this company. That's a share. You have a share of it. So there's common stock, then there's penny stocks. Now you can trade options with those, and options is basically making a bet within a certain time frame that the price is going to go up and down to wherever your target is. So these options are offered by various people. It can be retail investors, it can be market makers, it can be hedge funds, all sorts of things. But there has to be somebody who is selling you these contract or these shares in advance. So again, if you have something that you think is going to go up, let's say you think it's going to go to $100 at a certain date, and that certain date comes and it's actually now above $100, let's say $110. Well, whoever sold you that contract now has to pay $110 per share with however many shares that you bought. And that is how options work. Now, let's say you made that same bet that something is going to go to $100 and at a certain date, and it ends up going lower than that. It doesn't reach the $100. So that bet that you made is pretty much worthless. And if it's worthless, what ends up happening is the seller, whoever sold you that contract, profits on all of it. They take your money, whatever money you bet on that. So somebody is going to profit off of those options. It can get a little bit more complicated than that, but this is just a simple introduction video. So in simple terms, that's how options work. And futures can get a little complicated when basically it is a basket of a commodity. So what I like to trade is US futures, US indices. And US indices or US indexes is basically just a basket of US companies. So instead of individual companies like common stocks, we have a basket of them. And in futures, we're basically saying we think the price is going to go up in correlation with the average of all these companies, or the price is going to go down, right? So that's what futures is. The value of it can go up, not truly based on the valuation of the companies, but it can be from speculation, or it can be from motivation driven from buyers and sellers. And Forex is basically the comparison between two currencies. So for example, Euro USD, and also Forex is always going to be in pairs because obviously it's the comparison between two currencies, right? So for example, euros and US dollar, if you pair it together in the Forex pair, let's say it's priced at $1.09. Well, every dollar of euro is worth $1.09 of USD, so that's how that works. So I know it's a lot to take in, but it's actually pretty simple once you get, the introduction into it. Now, to finish off this video, I want to say that day trading can be a very lucrative career. It truly is a powerful way to make wealth. But keep in mind that there's a statistic out there that 98% of day traders lose, which is true. Because if you count the people who just put their money in and put their money anywhere, lose money, and then quit, of course, that statistic is going to be skewed. Trading is a very possible thing, but it is a very difficult thing. I would argue that it is one of the hardest jobs in the world. Not the most useful or the most important, but yes, I would argue that it is one of the hardest jobs in the world. Day trading has no true barrier to entry. It's not like being a doctor where you need multiple years of education before you're able to practice and before you're able to work. With trading, as long as you have money and you want to put it in the market, you can do it. You're going to understand more about yourself emotionally, what your belief system is on money, because every trader is going to lose money at some point. That does not mean that you're going to be unprofitable. You can be profitable and very profitable at that. Like I said, very lucrative. But every trader has a losing trade eventually. Every trader will lose money eventually. And that doesn't mean like actually lose money, but they will lose money in that day or that week or that month. And this is because trading is based on probabilities. It is based on, making a bet. And that might scare a lot of people, but it's not truly like gambling. Because when you have a true strategy, such as the Wyckoff method, that is proven to be profitable over 80% of the time, essentially you are not gambling anymore. You know exactly the true probabilities of you making money. You know you will make money. And that feeling of whether or not you're going to get it all today, lose it all tomorrow, will vanish. Because you have systems in place that will prevent that from happening. And these are the exact systems that I'm about to teach you now, is how to make this money, how to keep this money, and how to never give it back without worrying that you are going to give it back. But trading can be gambling. It can be gambling if you do not have a system in place, if you do not follow your system, and if in general you just do not have the emotional capacity to handle winning and losing. You're going to build some humbleness, and then you're also going to build confidence all in one. It's going to be a very big balance. And you need that balance. Every trader needs this balance, because if you're not capable of having that balance, it's just not going to work out, because eventually you're going to give your money back. And you have to understand that this works because of your process. Now, I don't want you to get scared, because again, I've taught hundreds of students successfully, a lot of which makes multiple six figures a year now. And some of which have started from scratch, knowing nothing. Because it's not like a regular job where you're getting paid hourly, that no matter what, as long as you show up, you're getting paid. That's not how trading works. And that's going to mess with a lot of you, and especially, like I said, emotionally. Because you're going to put a lot of effort in, you're going to put a lot of hours in, and you might have even a losing day or a losing week. And you're going to, feel a certain way because you're not used to putting in effort and time, and showing up, and not only, just not making money, but even sometimes getting money taken away from you. And this is an obstacle that you're going to have to get past, because like I said, you're not getting paid hourly. You're getting paid based off of the decisions you make. You can make a lot of money in a short period of time. It's because you're paid based off your decisions. You're not paid based off your time. But you have to use time to study, and you have to use your time to understand what to do and all the material that's being given to you. So, it's not going to reward you based on showing up, but it will reward you once you have the knowledge on what to do. These are just a few obstacles and some things you should be aware of before you start. So what we're doing, just as if you had a piece of paper with a graph on it, it's going to be on your computer instead. It's going to be a digital graph, but it's going to be a real valuation of something, of some commodity. And so you're going to just be able to track it real time, because you're going to be using it on the computer. Back in the day, people weren't able to do that. They had to either go into a building to buy stocks, or call in to a firm in order for them to buy stocks of a company or something of that nature. But nowadays, we're able to do it in the comfort of our own home through a computer. So your regular bank is more than likely not going to be able to trade commodities like futures or Forex, or even common stocks more than likely, but these brokerages will. And so you're going to have to open a brokerage account in order to trade, and you're going to connect that brokerage account that you're going to put money in into TradingView. So you're going to put money into your brokerage account, and then you're going to connect that brokerage account to TradingView. And that's the application that we use to trade out of your brokerage. And then there's also prop firms. So prop firms, proprietary funding firms, are companies that will lend you money, not to actually spend or use, but to trade with. So you're going to trade with this set amount of money, and you can't use it for anything else. They won't let you. And you're going to try to make money with it. And the only thing is, these prop firms have very strict rules. And even profitable traders will lose an account from time to time. So it's best, if you're going to go with the prop firm route, to make the money from the prop firm and put it into a personal brokerage, so that you're able to trade with personal funding, so that you can avoid their rules. There's a good chance that you will probably lose that account at some point in the future, which makes it unreliable. But it's also the fact that some of these prop firms will end up saying no to paying you, because their target audience and their target customer loses money, because you're going to pay a fee in order to get a prop firm account, and paying them this fee is basically allowing you to have the privilege or the opportunity to trade with their money. Most of the time it's trading with their money, but it's like simulated funds. It's not actual funds in the market. But once you prove yourself, then they'll start to move you to real money. But it's all the same anyways, because it doesn't matter. You can't use that money for anything anyways. They pay you based off of how much you make after a certain set of limitations. So thank you guys for watching. My name is Tony with Success is Imminent Trading and Coaching. Let's move on to the next lesson.